Acho, não tenho certeza que é um grande prazer estar aqui representando a Avenue, conversando com essa referência do mercado, Mr. Howard Marks, e é um prazer, de novo, ter vocês aqui. Espero que contribua bastante para o evento. Well, Mr. Marks, or should I call you Mr. Cycle?
Well, we say in America, we say, call me anything you want, but don't call me late for dinner.
That's a good one. He's sharp, as you can see. Well, it's a great honor and pleasure to be here representing Avenue in front of this qualified audience. We have some questions. I think we don't need to introduce much who you are. For those who doesn't know, I strongly recommend you guys to read his books. Mastering the Cycle, and the most important thing is amazing. It really helped me in my career to understanding the cycles, and I think we're gonna learn a lot about this today. And to begin with, and going straight to the point, Mr. Marks, could you please introduce yourself and Oaktree Capital to the audience and talk about your path in the market and why non-investment grade credit has caught your attention so much?
Well, I'm glad to do that, Will. I couldn't make out much of my introduction in Portuguese, but I did hear the words Wharton and Booth School. So the audience knows that I attended those schools, and I had summer jobs at Citibank during school, and then joined full-time in the investment research department for equities in 1969. I progressed there, becoming director of research for equities in 1975, and then in 1978 began to manage money. I was asked to start the bank's high yield bond fund. 1978 was the beginning of the high yield bond world. I was very fortunate to be there at the beginning, and that was the time, the year when it became semi-respectable to invest in non-investment grade bonds. The high yield bond fund I organized there was the first high yield bond fund from a mainstream financial institution. I did high yield bonds and convertible bonds over the years. In 1980, I convinced Citibank to move me to California just because I wanted to live there. And then in 1985, I shifted from Citibank to Trust Company of the West, TCW Group. And there I was joined by my colleagues with whom I started Oaktree, including Bruce Karsh, my co-chairman and co-founder, my partner. And Bruce had the idea of investing in distressed debt. So we organized a distressed debt fund at TCW in 1988. And again, that was the first distressed debt fund from a mainstream financial institution. So again, lucky to be in at the beginning. And Bruce and I and three other of our partners left in 1995 to start Oaktree, basically to do the same things. At the time we left, we were managing money in convertibles, high yield bonds, distressed debt, and distressed mortgages, which became our real estate business. And we had $7 billion under management. And we never asked whether we would get back to $7 billion. And of course, since then, non-investment grade debt has become more respectable. The hunger for return has caused people to move into alternative investments. I believe we are the alternative investments firm with the longest, strongest background in credit. And so as a result, today we're managing close to $200 billion. Investment in credit has become a mainstream of many institutional portfolios, and we're very well positioned with the best record, I hope, but certainly the longest record and the most experience. So that's me, and that's Oaktree.
It's really impressive, the achievements, and I think you touched already in like how Oaktree differs yourself from the other alternative investment firms. But if you can, in a nutshell, just to describe a little bit more, like how specific and the knowledge that Oaktree brings to the table for our clients, for our advisors, how you could describe this in Oaktree and how it differs from the other alternative investment firms.
I'll be glad to, Will. Since we were the pioneers in many categories of credit, we had to overcome resistance. We had to convince the people we wanted to invest with us that these seemingly risky activities could be engaged in with the risk under control. So that became Oaktree's mantra, good returns with the risk under control. We assured people that we would not deliver the full risk. Our goal was to have a good return, maybe the full return of our asset classes without the full risk. And I think that, most people equate skill with superior returns. I think achieving the same return with less risk is a great accomplishment. I'm very proud of having done that. I think we have actually beaten the benchmarks, but the key is that we've done it with less than all the risk. So if you look at our record, which of course stretches back to when we established these strategies at TCW, starting around 85, 86. So we have a record which is approaching 40 years now. I think that you'll see that for the most part, in each year, we either had a high absolute return or a very positive relative return. And that's what we have sought to do. That's what we promised people. And I think that's what we've delivered in all of our asset classes. And, the people in our business are proud to have high returns. I'm very proud of Oaktree's consistency. We've organized about 80 closed-end funds for our more aggressive products, where the money is locked up for roughly 10 years. And we've never had a fund that lost money before fees. We had one or two funds where the fees did not overcome, where the returns did not overcome the fees, so the net returns were negative, but never an investment return that was negative. We've had very high returns in the best cases, in the well into the double digits, but as I say, never negative. So this is, I think, what distinguishes Oaktree: consistency. We've had many competitors over the years who are gone now, not because they didn't have good returns in the good times, but because they didn't get through the bad times. And we always have. So I think that's how we established our position, and that's what we're known for today, Will.
That's good. That's grand. Mr. Marx, you discussed the significant shift towards high interest rates. We live in a different world post-pandemic, with high interest rates became the new normal, apparently, after 2 decades of really low interest rates. And you touched this on the sea change. It was a really interesting memo. How did Oaktree adjust its portfolio for all the opportunities, but also, as you mentioned before, it's really important, the risks in this kind of new market that we are navigating now?
First, let me explain what we mean when we say sea change. In English, a sea change is a significant, fundamental, lasting change, not just a short-term fluctuation, a lasting change in the fundamentals. And I wrote a memo entitled Sea Change. I write memos to the clients. I've been doing that for now 35 years. I wrote one in December of 2022 called Sea Change. And in that memo, I said that in 1980, I had a personal loan outstanding from a bank, and I got a slip of paper in the mail that said the interest rate on your loan is now 22.25%. Sounds like Brazil.
Yeah.
40 years later, in 2020, I was able to borrow at 2.25%. So interest rates went down by 20 percentage points, or what we call in the business 2,000 basis points, between 1980 and 2020. And if you came into the business or began to invest since 1980, which covers most people today, you have never seen an environment other than declining interest rates or ultra low interest rates. The Sea Change memo emphasizes the most recent period, 2009 through 2021. At the beginning of 2009, the Federal Reserve Bank of the US, took the Fed funds rate, our benchmark interest rate, to zero to fight the global financial crisis. And it stayed quite low until the end of 2021, when the Fed decided to raise rates to fight inflation. And it gave up on inflation being transitory and decided it had to raise rates significantly. So that's a 13-year period from the beginning of 2009 to the end of 21. And in that period, the Fed funds rate was zero most of the time. And I believe it averaged about 0.5% a year. When people live through an environment for a long time, they tend to think that's normal. And so we had a 13-year period of extremely low interest rates. We've had a 40-year period in which rates were either ultra low or steadily declining. People think that's normal. But my point is, it's not. Declining and low rates have a certain impact on investment outcomes. But if the environment is going to be different in the years ahead, if rates will not be steadily declining and will not be ultra low, I think the impact on investment outcomes will be different. And that's the point of the Sea Change thesis. By the way, all of my memos are available online at oaktreecapital.com. So you can see Sea Change, December of 22. Further thoughts on Sea Change that came out in October or November of 23. And then a memo in January of this year called Easy Money, talking about the negative effects of extremely low interest rates. But the key is that credit investing, the things that Oaktree does, high yield bonds, leveraged loans, distressed debt, and so forth, were not attractive, were not useful in the ultra low investment climate. And our returns were perhaps superior to others, but quite low in the absolute, especially in that 13-year period of 2009 to 21. Today, that's different. Today, the returns on credit are substantial. Take high yield bonds, for example. The average high yield bond today yields 7.5%. That's a good return, and it can be achieved consistently with semi-annual interest paid in cash. And these are promised returns. These are contractual returns between the lender and the company. And if the company doesn't pay you, the lenders receive the company through the bank's bankruptcy process. So the lenders have a lot of incentive to make the payments as promised. And this is a very attractive climate for credit investing, and very different from the last 13 years. And that's really the essence of the memo, Will.
Great times for oak tree, indeed. Well, saying that the sea change and everything now is different, and you see better returns. And given the current economic indicators and the global financial landscape, where do you believe we are in the market cycle? Since you are considered for a lot of people the market, the Mr. Market cycle, the Mr. Cycle, and you wrote books about. So the main questions, of course, the audience would like to know is where are we in the cycle, and which metrics and indicators we would closely monitoring to assess the potential for these shifts or inflection points in the cycle.
As you mentioned, Will, I wrote a book which was published in 2018 called Mastering the Market Cycle. I was writing it in 2017, and I got 2/3 of the way finished with writing, and I said to myself, well, hold on a minute. I've been studying cycles at this point for 50 years. I've lived through many important cycles. I consider myself thoughtful about cycles, but I was struck with the question, why do we have cycles? For example, the Standard & Poor's 500 stock index has returned about 10% a year on average for 100 years. But sometimes it's up 20 or 30, and sometimes it's down 5 or 15, or maybe even in a bad year, 25. Why doesn't it just return 10 every year? Why so much more and so much less? And what I concluded is that the best way to understand cycles is not ups and downs, which everybody thinks about, but excesses and corrections. And those excesses are mostly human excesses. So people get too optimistic, they take too much risk, they behave too aggressively, they commit to a lot of investments, they build a lot of buildings, start a lot of companies, build a lot of inventory, hire a lot of workers. Sometimes their behavior becomes excessively aggressive, and then it doesn't work. They're disappointed, and it corrects. So they back off. They stop behaving aggressively. Maybe they become defensive. They don't build new factories. They don't hire new workers. They let go of some of the workers they have. They reduce their inventories, and the economy contracts. So excesses and corrections in both directions. Sometimes excessively optimistic, correcting when it becomes too crazy. Sometimes excessively pessimistic, correcting when it becomes too depressed. So excess and correction, excess and correction. And that's all just preface to answer your question. At the present time, I do not see great excesses in the U.S. economy or the U.S. markets. The P/E ratio, the main metric for stock valuation, is a little higher than usual. So I think that if you measure stocks by the S&P 500, the P/E ratio, the price-earnings ratio is 22 today. The post-war average is 16. It's about 20% or 25% higher than usual. However, most of the extremely high multiples are in a handful of very prominent tech stocks. The vast majority of stocks are not valued terribly high. I don't see excesses of optimism. I don't see overheated sectors of the economy. We don't have too many cranes in the sky connoting excessive construction. We don't have too much equity inventory building. We don't have too much bullishness in the markets. Most people are a little bit worried about the geopolitics and the global macro. So nothing. It's not that stocks are cheap today. They're certainly not cheap. They're probably not even normally valued, but they're a little high, but not that much to worry about. So I think if you take a long-term approach of 3 to 5 years, which of course you must, nobody knows what's going to happen in the next year. But if you take a 3 to 5 year approach, I think what we have to worry about is that the return from the U.S. stock market may be lower than usual, but I don't see a catastrophe in the making. Now, in credit, the good news is, as I said before, the promised returns are higher than they have been for a long time, and quite, in my opinion, satisfactory in the absolute. So you can buy high yield bonds, which yield 7.5, so-called senior loans, which yield 8.5 to 9, and those are fully liquid securities. Or you can move further out in terms of risk and invest in private credit and get returns of 10 or 11, maybe more. Then, of course, if you move out from there to the distressed sector, we hope even better. But the point is that I think the returns from credit today are high in the absolute and can be earned with pretty good dependability. The period of declining and low interest rates was a great time to make levered investments, to borrow money, to goose up your returns. Strategies like private equity were invented in that period, so of course they did well. Today, I don't think levered strategies are as attractive because, again, rates are not so low and are not declining. But I don't think you have to lever to get good returns because the promised returns on credit are more than satisfactory. I hope that answers your question.
No, indeed, definitely exciting for the credit marks, not so much for stocks, but the return is there, potential is there. Navigate just a bit outside of the market cycle and the macro environment. You, through your life, you lived a lot of different cycles. You experienced a lot of things in the market. What are the key lessons that you would bring to the audience? Say about what did you learn navigating through all these cycles, what it is important for an advisor, an investor to know, to go through the cycles as you did?
I think, Will, the most important thing is for would-be investors to practice patience, and not be hyperactive. You don't make money by buying, selling. You make money by holding good investments for the long run. Remember, 10% a year for a century. If you invested at 10% a year 100 years ago and held, very hard to do. The first requirement, of course, is to remain alive for 100 years. A dollar would have become about $15,000 by now, just by compounding at 10%. So the most important thing is to invest. Invest early, invest patiently, and hang in there. Don't get scared into selling when things go bad. Don't get too excited and take too much risk when things go well. Steady she goes. Excellent results will follow. That's the most important thing. The second lesson is related to that. And as you know from reading the memos and so forth, people should never assume that they know what's going to happen in the macro world, that they never know the twists and turns of the markets or of the economies or of the companies. It's very hard to predict outcomes in what's called the macro, the big picture. And it's not necessary if you're patient and you hang in there and you invest for the long term. So, my last memo, which came out a week ago today, was entitled "The Folly of Certainty." You should never assume that you know what's going to happen. and change your behavior on that basis. Rather, take a humble, patient approach and be a disciplined, mature, long-term investor. I think that if you do that, success is I'm going to stop my phone from ringing here. Is practically guaranteed.
Really nice to hear from successful guys saying about being humble. I think the market quite teach these lessons to us every day. And just moving forward back to the macro or the outlook or the global environment.
But let me say one thing to illustrate that. Yeah. The great American author and humorist Mark Twain said, "It ain't what you don't know that gets you into trouble. It's what you know for certain that just ain't true." Humility and understanding your limitations is not a risk. The risk lies in a lack of humility and an expectation that you know what lies ahead. Behaving boldly on that basis, that's how you get into trouble. So, if you've been around as long as I have, you've learned that lesson the hard way, and hopefully you've incorporated it and survived.
Yeah, that's great. Thank you. So then moving forward back to a bit of the global macro environment, after all the capital influx that we live, there's a lot of money being printed and all this kind of thing, and also the kind of complex global macro environment that we live. How do you see the risks? If you perceive any asset class that you can see, like you already said that you don't see like the stock market kind of like with a bubble behavior, but do you see any asset class that would show or exhibiting a bit of like a bubble-like behavior? Do this substantial liquidity?
Well, I think that I mentioned that the U.S. stock market has been led by a handful of highly performing tech stocks. NVIDIA, which makes the chips for AI, is the greatest example. It's done fabulously. It's up hundreds of percent recently. There are some people who think that's been excessive. I don't know enough about it to know whether it is or isn't. But that's the market segment that has some people worried. Again, I'm not saying it's risky, and I'm not even saying that I'm knowledgeable in that area. But I feel today that most people are aware of the fact that there are always short-term uncertainties in the marketplace. I think that most asset classes are priced to reflect those uncertainties. So, most things are a little strong. Most prospective returns are positioned to be a little bit below average in the short run, but not so bad that one should get out of the market and miss the opportunity. It's easy to say, "Oh, the market's high, I'm going to get out, or I'm going to stay out, or I'm going to avoid investing. I'm going to wait till there's a better opportunity." But number one, you may be wrong. A better opportunity may not lie ahead. And number two, when the opportunity comes, if securities correct and collapse and the prices become much lower, most people get scared off by that and fail to take advantage of that buying opportunity because they're too pessimistic. So it's just not worth trying. Charlie Munger, my friend, Warren Buffett's partner, who passed away in November, said that trying to time the market, it's a two decision problem. You have to decide when to get out, which is hard, and then you have to decide when to get back in, which is hard. And doing both correctly is unlikely and not worth trying. And the reward for getting in and staying in throughout is much more dependable than the hoped for return from getting in, getting out, getting in, getting out. Very few people have done that successfully over the years.
Thank you. Well, we received some questions from the audience as well, from the ones that here and the ones that are watching us on the internet. And I would like to follow to you. To begin with, in a world like which is characterized by a lot of changes, high inflation at some point, and then the inflation go down, geopolitical tensions. What kind of advice you would offer to individuals that they seek to protect themselves, but also at the same time to profit in this environment? Like the two things: how to protect themselves in this environment that has been changing quite a lot, and how also to profit with this type of environment.
Well, first of all, that's a great question because it gives me an opportunity to say the following. When people try to make high returns, they must take risks that endanger their capital. If I believe today, let's say, investors can make a dependable 7, 8, 9%, let's say. We can talk about ways to do that where 5 years from now, I would be very surprised if you haven't made 7, 8, 9% and protected your principal. Now you say, Howard, that's not good enough for me. I want to make 15. To make 15 in this world, you have to take risks, which mean that you could instead of making 15 or even the 8 I'm talking about, you could make 2 or 0 or lose 3 or 5. So you must recognize that everything you do to increase your return beyond the basic safe level introduces some risk to your principal, to your capital. If that weren't the case, everybody would do it. And if everybody did it, you wouldn't offer returns of 10 or 15 or 20%. So safe return dependably, higher returns possibly, or possibly not. I think that's the important thing to bear in mind. And when you can get dependable returns today, like you can through credit in the 7, 8, 9 region, or more if things go well, why take increased risk to try to get 11, 12, 13, 15? Buffett says, why risk what you have and need to get what you don't have and don't need? And I think that's a very well thought out way to look at it.
Thank you. Another question, since we are in Brazil, I'm not going to ask you about Brazil specific, but considering like a global opportunities, where do you currently see like a compelling investment opportunities around the world? In most of course, in the credit market that you know a lot about. So if you can just share some ideas, perhaps outside of US.
Well, this really illustrates the basic situation. I think the U.S. has an excellent, dependable, well-functioning economy and capital market. And so you can invest in the U.S. and expect to have safety of principal, legal protection, and a good return. But because of these attractions, the U.S. market is highly priced and does not offer a bargain. You can go outside the U.S. to Europe, perhaps, where things are not quite as good, and try for higher returns, and have a fair chance of getting them. If you want to go even further for higher returns, if you want to find the bargains, you have to look at things that are a little less clearly attractive. For example, the ultimate example is China. Now, many investors consider China uninvestable, largely because of geopolitics. What will be China's role in the world? How will it behave? Will it be belligerent? Will it be hostile? Will there be war? Um, uh, the Chinese government uh, expresses hostility toward the U.S. and much of the developed world. It sides with North Korea, Russia, Iran, and so forth. So people say uninvestable. But because they say uninvestable, the stocks uh, and other assets have fallen significantly. Are the declines appropriate, not enough, or excessive? And so, this is an example of a market that people don't feel good about today, but because of the bad feelings, maybe maybe the prices reflect bargains. You have to understand good feelings usually are connected to high prices because people feel good about the assets. Bad feelings, people's worries, usually are connected with low prices. And maybe the prices are low because the worries are deserved. Maybe they're excessive. These are not uh, sleep at night markets, these risky markets. These are markets where you take incremental risk to try to earn an incremental return, and you're going to have some bad moments and maybe some sleepless nights. If it works out, you make the high returns. If it doesn't, you have significant losses. The potential for loss always accompanies the possibility of extremely high returns. Always.
Okay, thank you. And reaching like the conclusions, first, if you can share any thoughts about the current market that you have, some reflections or investments in general that you believe would be valuable for the audience, and specific first in the current market, and then we can talk a little bit more philosophical or life. But to begin with, just like any thoughts about this market right now with geopolitical tensions, elections, and everything that's going on.
Many people say that today's world is more uncertain than at any time in their life. We have the hostilities going on in Ukraine and the Middle East. We have the geopolitics with China, Russia, Hamas, Houthis, etc. Many countries have political uncertainty. The U.S. has a well settled economy, but runs deficits and has a very high national debt, which entails some risk in itself. So the world looks like an uncertain place. Now, I will say this: the world always looks like an uncertain place. And when it seems safe and it seems there are no uncertainties, often that's an illusion and a dangerous illusion. Today, it seems uncertain. The risks are recognized and on the table. That's a healthy thing. And uh, there are many things. An example would be, the war in Ukraine turning nuclear and engulfing the continent of Europe. This falls into the heading of what I call an improbable disaster. It would be a disaster if it happened, but it's improbable. And so when you think about the potential for long-term compounding at 7, 8, 9, 10%, and you think about how much money that produces if you just invest steadily over the long run, then I think the key is that these improbable disasters that we all worry about must not be permitted to dissuade you from investing. The great hockey player, Wayne Gretzky, greatest of all time, he said, "You miss all the shots you don't take." So you take shots, some of them are not going to be unsuccessful, but if you don't take any shots, you're guaranteed to be unsuccessful. So I think the key is to invest, try to invest safely and steadily, patiently for the long term. And spend a lot of your mental energy trying to get through the tough times. When other people get afraid and sell out in tough times, you must be tough and say, it's scary, but I'm not going to sell out. I'm going to hold through. And historically, that has worked much better than trying to get in and get out with success. That's my most important lesson for the audience.
That's great. And more philosophical and for those who are like in a career, financial career, what would you say for our audience? Any thoughts in a philosophical terms, perhaps, or lessons for life from a guy that lived through the cycles and experienced a lot in financial market, and pretty sure that has a lot to share with us about that.
I think the important thing to recognize is that the markets present a very interesting riddle, a challenge to figure out, understand, and live with. And because of the role of uncertainty in the world, of randomness, of luck, of external influences like geopolitics, and even economic uncertainty, nobody gets it right all the time. So investing is not a field for people who are going to be uncomfortable if they don't get it right all the time. Because you can't. If you want to, there's a book out called Fooled by Randomness. It's about 20 years old now, but has some important lessons. And it's written by a guy named Nassim Nicholas Taleb. And he compares investing with dentistry. He says, if you go to dental school and you learn how to fill a cavity and you fill it that way every time, you'll be successful every time. So if you have the kind of mentality that requires being successful every time, become a dentist or an engineer or the things that are subject to science, not chance and not real world uncertainty. If you can live with uncertainty and you like a riddle, a puzzle, a mental challenge, I recommend the investing because it's extremely interesting and, if done right, extremely profitable. But you must bear in mind, a friend of mine in England wrote a book with a great title, Simple But Not Easy. The things we try to do can be simply described. They're just not easy to do. And anybody who thinks it's going to be easy is in for a disappointment. But if you're forewarned that it will be a challenge, and if you're up to the challenge, I strongly recommend it.
That's really comfort to hear that, I think, for everybody. Well, it's a shame that you are not here to enjoy our happy hour, but the invitation is here for you whenever you come to Brazil. Happy hour on us on Avenue. And it has been a pleasure to talk to you and to learn your lessons. Thanks again to be with us in this panel, and I'm pretty sure that the audience love it. Thanks.
Thank you, Will. I'm very glad to have been with you. I appreciate the relationship that I and Oaktree have with Avenue, and I look forward to taking you up on that invitation in the near future. Have a good day.
Thank you once again.